Cap rate explained. The number every real estate investor must know. Most real estate investors are leaving hundreds of thousands of dollars on the table because they don't understand this one number. And it's killing their wealth building strategy. Hey, I'm breaking down cap rates in the next 5 minutes. And by the end, you'll know exactly why this metric matters more than the property itself. Let's jump in. The cap rate problem. Here's what's happening right now in the US real estate market. Investors are buying properties based on emotion, location, and hope. They're looking at Zillow, falling in love with a house, and making offers without understanding the actual cash return they're getting. It's like buying a stock without checking the dividend yield. You're blind. The cap rate fixes that. Cap rate stands for capitalization rate, and it's basically telling you the annual return on your real estate investment expressed as a percentage. That's it. It answers one critical question. What percentage of your money are you actually getting back every single year? Here's the formula. Write this down. Cap rate equals net operating income divided by property purchase price. So if you buy a rental property for $300,000 and it generates $18,000 in annual net operating income, that's rent minus expenses like property taxes, insurance, maintenance, and vacancy. Your cap rate is 6%. You're getting back $18,000 on a $300,000 investment annually. That matters because it tells you instantly whether a deal is worth your time. Understanding the numbers. Let me give you real context because numbers mean nothing without comparison. In 2024, the average cap rate on residential rental properties across the US is between 4 and 7%. Depending on where you live. In hot markets like California or New York, you're looking at 3 to 4%. In secondary markets like Tennessee, Ohio, or Texas, you might see 6 to 8%. Now compare that to what you're getting in traditional investments. Your Roth IRA invested in the S&P 500 averages about 10% annually over time. A Fidelity high-yield savings account right now is giving you 4.8% with zero risk. Your 401k with company match? That's free money, often 3 to 6% instant return. So when someone's excited about a 4% cap rate rental property, they should be thinking, why would I take on all this landlord risk, tenant headaches, and capital lockup for a return that's lower than the stock market and barely above a savings account? That's the real question. The strategy shift. Here's where cap rates change everything about your investment approach. Higher cap rates usually mean lower purchase prices, which means less competitive markets, often secondary or tertiary cities. Lower cap rates usually mean hot markets where everyone's buying. Prices are inflated, and your actual return is weak. Let me show you the real difference with actual numbers. Scenario 1. You buy a property in Miami for $500,000. It generates $20,000 annually in NOI. Your cap rate is 4%. Your $500,000 is locked up for a 4% return. Scenario 2. You buy a property in Kansas City for $250,000. It generates $18,000 annually in NOI. Your cap rate is 7.2%. Your money is only half locked up and returning nearly double the percentage. After 10 years, assuming no appreciation in either property, Scenario 2 has given you $180,000 in net cash flow on your original $250,000. Scenario 1 gave you $200,000 in net cash flow on $500,000. But Scenario 2 kept $250,000 in your pocket that could have been working in index funds, REITs, or other deals. That's not luck. That's the cap rate showing you the smarter play. The real power. Cap rates also reveal when you're overpaying. If every comparable property in an area trades at a 5% cap rate and someone's asking you to Pay for a 3% cap rate. You now know exactly how much you're overpaying. It doesn't mean you can't buy that property. It means you know the true cost of that decision. And in personal finance, knowing is everything. The cap rate also helps you compare real estate to every other investment you could make. It's the universal translator. Should you buy this duplex or add to your Robinhood account? The cap rate tells you the answer immediately by showing you the actual return. Final move. So here's what you do next. If you're looking at any real estate deal, calculate the cap rate before you get emotionally attached. Net operating income divided by purchase price. If it's below 4%, you better have a strong appreciation thesis or you're just gambling. If it's between 5 and 7%, you're in solid deal territory. Above 7%, you're likely looking at a secondary market where cash flow is real. Use this metric to invest like a mathematician, not a dreamer. If this video helped you understand real estate investing better, hit subscribe. We're posting wealth building content every single week, and you don't want to miss it. Thanks for watching. Now go make smarter investment decisions. Word count: 847 words.